Hi folks, Joe Bongiovanni here from the Kettle Pond Institute for Debt-Free Money. Doing a coffee with Joe for Saturday, February 5th, 2011. I'm sorry that my partner Pete Young's not here with us tonight. Pete and I have been trying for several days to try to get another video together on a series that we're doing on the Dennis Kucinich bill, which is the National Emergency Employment Defense Act of 2010 that was entered into the previous session. Somewhere between Skype and call recorder, Pete and I have been unable to get our communications apparatus working properly, so I offered to Pete that I would try to do this video and have Pete try to put it together and get it posted. So having said that, if you can bear with me for the rest of this video, we did two videos really so far related to the bill. The first one having to do with the monetary authority and how the monetary authority was going to basically take over the principal role for determining the amount of money in the monetary system that would be in existence. What would the money supply number be, and how much would the money supply increase on an annual basis going forward? So that aspect of it, the creation of the new money, would be determined by, the amount would be determined by the monetary authority. It would actually be created by the government, it being a government function to create money. And then last week, or 2 weeks ago now maybe, we did a video on one of the mechanisms by which the money that was created would be coming into existence, being paid into existence by the government through the program called Monetary Grants to States, in which 25% of the new money created would basically go to state-identified projects basically on a per capita basis, nominally, so that the states could have money to implement their projects, be they infrastructure or otherwise. So having dealt with the monetary authority and determining the amount of money, and having dealt with the method by which the states would make money available debt-free, completely debt-free, on a completely debt-free basis, today we wanted to turn a little bit towards that transition away from fractional reserve banking to full reserve banking. And the mechanisms in the Act, primarily they're called the transition mechanisms in the Act, that would change over from what? From the private, debt-based, fractional reserved monetary system, temporary monetary system where money is created and destroyed by making loans, to the public, government-issued, debt-free, permanent money system that's envisaged in the Kucinich bill. And here we're talking about that aspect of it, the aspect of it that would take it to a full reserve basis. And you know, when Professor Irving Fisher wrote his 100% Money book back, I think it was in the early 30s, although he wrote on it earlier than that, but in his book 100% Money. And even in his writings that he's done for a number of economics textbooks all the way up until into the later 40s, he always, just said, well, what the government would do, they would just print up money. They would print up bills, and those bills would be brought to the banks, and those bills would substitute for the bank credit that's created on the basis of fractional reserve lending against checking accounts, against demand deposits. And now we've graduated, if you will, if you want to call it that, to the electronic age and computerized creation of money. Ben Bernanke likes to say that, we push a button at the Fed, and the next thing you know, there's $100 billion here or there. So we've moved up to that. So we want to talk now about how do we get from fractional reserve banking into full reserve banking. because full reserve banking is the linchpin to provide economic stability and financial stability to the national economy. It is the linchpin. It is the thing that says bankers will only lend real money. So having said that, where are we at? Well, there's basically, three components, if you will, of the money system that's going to be converted. The first is the currency, and that one is fairly straightforward. That is to say, an amount of the new United States money would be created in place of the Federal Reserve notes money, and it would, over time be substituted for. And it's pretty straightforward to make sure that there's enough currency to meet the currency needs of the country. But then we get into the bank credits, really the fractional reserved, credits, and that have been created. And what do we do about those? Well, here we turn to the banking system and we look at, because we're talking about the commercial banking system, and we look at the deposits that are on hand on the balance sheets of those banks. And basically, just like we were going to take, trillions of dollars of currency, there will be a date certain on which the switch would be made, and on that date, all deposits of the commercial banking system are transformed into United States money. They're still dollars, dollar US, but they're United States money. They're no longer based on the fractional reserve system. And then of those deposits, the ones that are checking account deposits, the rule is that there would be no interest paid. For savings deposits, there would be interest paid because savings deposits are considered to be loans to the banks, and savings now would have a time term deposit over which the person who gives the money to the bank cannot take it out. So on that time, the relationship between checking accounts and savings accounts would be reestablished to what it was back a long time ago, before all the deregulation started mixing and matching aspects of checking and savings accounts so that they could basically all be lent against fractionally. And we restored now the stability by having the proper differentiation between the account types. Then we move to the other part of the bank's accounts, and that is the outstanding credits and loans that the banks have made using that fractional reserve power. Now, again, on the date certain, what would happen is that all of the assets that are on the bank's books that result from credit extending, would become a liability of that bank to the United States government. The United States government has just made those United States money. All those bank credits are now United States money. The government has done that. And now, properly, the bank, in collecting that United States money, is going to pay the principal that it collects to the United States government. So, in a fell swoop, so to speak, we've taken care of the deposits and we've taken care of the loans. Now, what happens with those loans with regard to that money? The Monetary Act, this Monetary Act, establishes for the Monetary Authority at the Department of the Treasury a revolving fund account. That money is going to go into and out of that fund, and that fund is going to be receiving those dollars in payments. The banks are going to keep the interest payments, that are going to come in on those loans. At that point in time, we have basically established a full reserve basis for banking. Banks will all have real money, and all loans in the future will be made by United States money as real money. So that's pretty much the description of how it would work. What else can happen with the money that's paid in and is covered? For instance, it can be relent to the banks if there's a shortage of capital in any location or anything like that. It's all covered in the Act. Thanks very much for listening.